now move over to the retail market snapshot from a tenant perspective. We'll have Gillian with the leasing trends, and then we'll look at large format, the shopping centres and CBD overviews, and then of course we'll look at the tenant perspective.
Okay, thanks, Ed. So looking across our retail markets, vacancy has decreased in large format retail and remained static across other areas. I think we touched on it at the last market update, but in terms of population growth to new retail stock, there's very low levels of new retail stock coming to the market, which is why we've seen vacancy decrease or stabilise across all those markets. And look, despite a slump in retail spending with households tightening their belts in response to, rising cost of living, it's the lack of stock that is putting upward pressure on effective rents. So we're seeing rents go up, incentives come down across most of those retail markets. And also across all markets, annual increases are up. I guess some small relief for our retailers is CPI is continuing to ease somewhat, with the last quarter down to 4.1% overall. However, as most reviews are based on CPI plus percentage, it's still not an insignificant increase, particularly given the current retailing environment.
Thanks, Gillian. So as Ken highlighted the barometers within the office market, the lease norms for retail remain unfriendly due to the supply side power and market coverage that landlords hold as a collective over retail tenants, as well as restrictions within retail leasing acts. With the market conditions, they're quite varied over the different types of retail. In theory, they should favour the tenant. However, landlords are not taking into consideration the needs of the tenants, especially in light of the current economic conditions. As an example, with the retail market experiencing difficulty due to inflation and interest rates, incentives are rarely provided by landlords due to the increased cost of borrowing. If landlords are making changes due to inflation and interest rates, they should be acknowledging the difficulty experienced by tenants and equally reducing rents or rent increases. Unfortunately, due to the fragmentation of retailers, the shopping centre landlords especially are unwilling to negotiate, and the tenants therefore placed in a difficult position to either accept their terms or potentially have to vacate. So with large format retail, the economy is continuing to have an effect, with household goods falling 2.6% year on year in September to November 23, although there were strong sales in November throughout the Black Friday period. The interest rate increase in November dampened consumer confidence throughout the Christmas period, with consumer sentiment remaining at levels last seen in the recession of the late 1980s and early 1990s. The confirmation this week of Godfrey's going into administration highlights the current difficulties for retailers, and more examples of this will occur without recognition and support from landlords. The lack of new properties or space in the large format retail area is forcing rents to increase, with limited opportunities for new and relocation sites. However, for some tenants, the rent increases along with the hike in construction costs is making new sites difficult to justify. Landlords are continuing to resist incentives on both renewals and new sites, given the increased cost of borrowing money. Time and skill is required to achieve results in this area. Currently, our large format clients are looking at existing sites from a portfolio perspective, with careful consideration and decision-making based on informed data to either remain in situ or relocate to a superior location, especially given fit-out costs and reduced amount of CapEx available. These strategies always have an end in mind to provide the greatest return for both the individual stores and the portfolio in general. With shopping centres, the rate of inflation is really influencing how customers shop, with a reduction of spend on non-essential products, researching product pricing, and an increase in awareness of sales, cheaper products, brands, and stores. Shoppers are also more purposeful with their shopping, so having the right experience, products, and staff are more important than ever to ensure healthy sales conversions. And an example is Lego, where there is a very strong focus on the customer experience from when they walk through the front doors. Whilst November retail trade figures saw a 2.2% year-on-year growth on the back of Black Friday sales, in effect it is negative growth when you consider inflation and wage increases are negatively impacting profit margins. Unfortunately, there is no silver bullet for recovery in the short term for retailers until interest rates reduce and the stage 3 tax cuts mid-year come into effect. Recent data from Kepler Analytics showed that both passing by and inside traffic was significantly down in December 23 compared to the same period last year. However, shopping centre landlords are still seeking rent increases on renewal by 10 to 20%, along with longer-term leases and fit-out upgrades. Many tenants in larger shopping centres continue to be affected by relocations on renewal as the landlords revisit tenancy mixes and seek international tenants to maximise turnover and rental growth. As we discussed with large format retail, landlords are only providing incentives on new sites, and even then the amounts are reduced or reflected within a higher face rental. With the CBD, retail rents have remained stable over the past quarter due to the effect of interest rates and reduced discretionary spending. However, the CBD will more than likely never return to pre-COVID levels due to the change in office working habits. Retailers dependent on office workers, for example, small to medium food tenants within a foyer or precinct in an office building where there's been low visitation or higher vacancy, residents or overseas tourists are continuing to struggle to survive. In the suburban market, again, food tenants and those with large amounts of discretionary products are continuing to suffer, this time relating to the cost of living pressures. Landlords need to continue to provide flexibility and recognition of the pressures on retailers. Just this week, we've encountered a landlord with the case study they've shown on the right-hand side in inner city Melbourne who has tried to pass on unfriendly terms to a tenant, including rent increasing in line with the landlord's interest rate increases, no compensation for interruption to the building while it's being developed, and discouraging the tenant from using an expert advisor. Unfortunately, this is a common example where landlords use their power to take advantage of SME retailers. Looking at the tenant perspective, there are a number of strategies that a tenant can enact to receive favourable outcomes within the retail sector. In orange, we've highlighted two strategies that have relevance to the case study previously shown. So firstly, premises due diligence and negotiation. Ensure that you're well equipped to negotiate your lease to be able to get the best outcome that your business requires. If your landlord is not prepared to share in the risk of the lease, then that may be a warning sign to look elsewhere or engage an expert to negotiate on your behalf. Secondly, co-opetition with other tenants. So you're well equipped to negotiate your lease, speak to other neighbouring tenants, join or form a local traders committee to share information, both of which takes the power of information away from the landlord.